I'd like to share some important insights from Jerome Powell today. You see, Jerome Powell holds a significant position as the chair of the Federal Reserve, making his words quite impactful. He addressed a gathering at Jackson Hole, a high profile event where influential figures like central bankers, politicians, and the ultra wealthy gather. This exclusive economic assembly, taking place from the 24th to the 26th, offers us a unique window into their thoughts and plans, particularly in anticipation of their upcoming September meeting. Let me break down Jerome Powell's statements for you. He emphasized that despite a decline from its peak, inflation remains at worrisome levels. Powell indicated that the Federal Reserve is fully ready to increase interest rates as a response. This move is intended to manage the inflationary pressure more effectively. It's crucial to note that their aim is to maintain inflation at a 2% target. Now, let's delve a bit deeper. Powell acknowledged that while there has been some improvement in inflation numbers, he believes it's not sufficient. He expressed the need for more progress in this direction. He mentioned that the lower core inflation readings in June and July were positive, but he cautioned against interpreting them as a definitive shift. For Powell, these 2 months of data represent only initial steps toward achieving a considerable reduction in inflation. To sum it up, Powell's stance underlines the importance of sustained efforts to bring inflation down to their target. This message carries weight as it sets the stage for the upcoming gathering and subsequent discussions. Additionally, it's worth noting that Powell's statements were just a part of the picture. There were also comments from other Federal Reserve representatives at Jackson Hole, and I'd be happy to share those with you too if you're interested. Powell went on to explain his understanding of the balancing act between the risks of doing too much and doing too little. Essentially, he expressed that if interest rates aren't raised sufficiently, there's a possibility of resurgence in inflation. But if they are raised excessively, it could lead to unwarranted harm to the economy. It's not just about the level to which interest rates are raised, but also about how long they are maintained at those heightened levels, which underscores the importance of the duration. In his words, Powell stated that insufficient action might allow higher than desired inflation to take root, while excessive measures could inflict unnecessary damage on the economy. Sharing my perspective on Powell's statements, they come across as leaning towards a more cautious stance, undoubtedly reflecting a hawkish sentiment. I'd find it hard to view it as dovish when Powell acknowledges the potential need for further interest rate hikes due to high inflation. However, the stock market's response wasn't particularly pronounced in either a positive or negative direction. This is likely because the market had anticipated a hawkish tone from Powell, but the actual remarks weren't as hawkish as anticipated, resulting in a moderate reaction. Undoubtedly, Powell's viewpoint carries substantial weight and influence. Yeah, it's essential to consider the perspectives of other members of the Federal Reserve as well. For instance, Susan Collins, the Fed president of Boston, also shared her thoughts at the Jackson Hole event. Collins indicated that the Fed might have to raise interest rates even higher. She suggested the possibility of requiring additional increments, possibly nearing a point where rates can remain stable for a considerable duration. This aligns with the notion that interest rates might not have peaked at 5.5%. As Collins pointed out, this observation is significant. Once the Fed ceases its upward adjustment of interest rates, there's no immediate expectation of a rapid reversal to rate cuts. The Fed is unlikely to embark on interest rate reductions soon after the hiking phase concludes, while some are speculating that it could take up to a year before interest rate cuts come into play. I personally hold a different view, believing that the timeline won't be as extended. Here's some insights from my recent video, which I posted about 3 days ago. In that video, I delved into the historical trends of the Federal Reserve's actions and how they relate to interest rate cycles. Traditionally, after reaching the highest point of interest rates in a cycle, the Federal Reserve typically began cutting rates within about 3 months based on an average of the past 18 interest rate cycles. However, in the most recent interest rate cycles, there's been a notable shift in this pattern. Following the peak interest rates, the Federal Reserve has taken longer to initiate rate cuts, sometimes waiting between 5 to 15 months before making any reductions. In my personal viewpoint, I anticipate that this time around, the Federal Reserve might need to start cutting rates within a year of reaching the peak. First Merkais believe maintaining peak rates for a full year or more could pose challenges. I plan to delve deeper into this perspective in a future video. Interestingly, a statement from Collins contrasts this historical norm. She expressed a high likelihood of needing to maintain rates for a considerable period, but refrained from pinpointing the exact peak. This suggests that the Federal Reserve may not adhere to the previous practice of initiating rate cuts shortly after reaching the peak interest rate. It's worth noting that Collins also acknowledged uncertainty in determining whether the peak rate has been achieved. Currently, the Fed funds rate stands at 5.5%. Speculations abound, some suggesting we've already hit the pinnacle, while others propose a further increase to 6% or even beyond, contingent on inflation's trajectory. In essence, it's crucial to understand that keeping interest rates at these elevated levels for an extended duration could strain the U.S. government financially. This stems from the necessity of allocating more budget resources toward interest expenses, given the accumulation of new debts and the ongoing need to refinance existing ones. This fiscal scenario isn't sustainable in the long run. Shifting gears, let's explore an opposing viewpoint. Philadelphia Fed Bank President Patrick Harker believes we've already reached the peak interest rate at 5.5%. He conveyed that the current rate increases are imposing restrictions, prompting him to advocate for maintaining these rates for a substantial period. According to Harker, this stability is anticipated throughout the remainder of the year, as succinctly expressed in his direct quote. Naturally, Harker isn't the sole decision maker here, but rather, he's contributing his perspective. Harker asserts that he thinks the Federal Reserve doesn't need to further increase interest rates, considering the current level is sufficient. He also adds that the Federal Reserve is unlikely to decrease interest rates in the immediate future. However, the noteworthy point from Harker's remarks is that if inflation subsides more rapidly than expected, they might opt for earlier interest rate cuts. This possibility should be kept in mind, as it's a significant consideration. This leads us to a crucial concern that many people find worrisome. Thomas Barkin, the president of the Richmond Federal Reserve, highlights that robust economic data could reignite inflation. This reasoning aligns logically. If the economy is performing exceptionally well, inflation could make a strong resurgence. Consequently, the Federal Reserve might be cautious about promptly reducing interest rates. In my assessment of the present situation, we're nearing the zenith of interest rates in this economic cycle. The decision in September hinges on the August inflation and job reports. Whether the peak rate stands at the current 5.5%, increases to 5.75 or 6%, the Federal Reserve seems poised to uphold these rates for a considerable period, a stance that could be detrimental to the economy. Elevated interest rates tend to have adverse effects. To conclude, let me share the current probabilities. Ahead of the Jackson Hole event, the CMA FedWatch tool indicated an 85% likelihood that the Federal Reserve would refrain from raising interest rates in September, with a mere 15% chance of a rate hike. Following Jerome Powell's statement, these odds have shifted. Presently, there's a 20% chance of a rate hike and an 80% chance of no change. Nevertheless, it's essential to note that these probabilities will shift again following the release of the August job and CPI inflation reports. So that's your update for today. Please subscribe. Thanks for watching. Until next time.